Okay, let's kickstart because we have a lot of content, and let's start with some of the preliminary introductions. Good afternoon, everyone. So today we will be holding our webinar about transfer pricing for intergroup financing in Asia. So the reason we pick up this topic is because intragroup financing, and particularly loans, is a transaction that is very common in the Asia Pacific region. And because it's very common, it is a focus point of the tax authorities, and also is a common transaction that falls under audits with the tax authorities. So hopefully today we are able to cover and give some tips on how to deal and how to manage intragroup financing within the organizations. Before we start, let me just do a brief introduction about our firm, just a disclaimer about this presentation being for guidance and discussion purposes only, and it should not be taken as formal advice. So for those who are new, our firm specializes in providing practical, proactive, and cost-effective transfer pricing advisory for multinational companies in the Asia Pacific region. We have offices in Australia, Singapore, Malaysia, and UAE, from which we cater to the Asia Pacific region. Some just accolades that we have on awards, and also some rankings as a tier 2 firm. And as part of our contribution, apart from doing webinars, we also teach in different forums in Singapore, Malaysia, and Australia. A brief introduction about who will be speaking today. Even though I should have started with Honchan, I'm going to start with me today. I'm the Director of Transfer Pricing Solutions Asia and Malaysia, and co-founder with more than 15 years of experience advising multinational companies in the area of international tax and transfer pricing. And I also have with me Hon Chuan Tan, who is my co-panelist for today, who has more than 10 years of experience in transfer pricing and tax, developing transfer pricing firm prior to joining Transfer Pricing Solutions in 5 years ago now. He has a lot of experience with transfer pricing planning, risk management, documentation, country-by-country reporting, tax-effective supply chain management in the Asia-Pacific region, Australia, the US, and UK. So he will also give us a lot of input on some of the views of Australia and maybe hopefully Malaysia as well, on how tax authorities view financial transactions. So with that, let me just start with giving some background on when we are dealing with financial transactions, what type of transactions are we dealing with? So we can say that maybe there is around 5 very common transactions in the context of transfer pricing. Obviously, the first one is loans, which is basically a term loan that is given a specific amount for a specific repayment schedule and a fixed or a floating interest rate. So that's the most common transaction that we have within transfer pricing and within multinational groups. You can also have bonds, which is a debt security issued by a corporation and sold to investors in exchange, where the backing of the bond is typically the payment ability of the company coming from money earned from future operations. We also have cash pooling, which is basically a way in which a multinational manages short-term liquidity issues and keep financing costs to a minimum by having several subsidiaries located in different countries and sharing basically the excess cash. We have also financial guarantees, which is an unconditional promise to service a debt in the case of the borrower will not be able to fulfill the contractual obligation to make timely payments. And we have also performance guarantee, which is an assurance offered by the guarantor that the guarantee entity will perform work as contractually agreed. So within all of these transactions, just to pick on Honchon, what's the most common one?
Yeah, I think generally it'll be loans, right? We'll be looking at always loans, bonds as well. I mean, using bonds as a testing tool as well, but generally we'll be looking at loans. cash pooling and financial guarantees. I think those are generally for like bigger multinationals that they will.
Yeah. Nevertheless, I think I have observed in the last year or so, cash poolings have become a little bit more common, mainly because interest rates going up. Everyone is trying to optimize cash management within multinational group, and cash pooling is a good way to optimize cash and not having to go and lend cash from banks, and rather than utilizing the cash, excess cash in different countries internally. So they have becoming a little bit more common over the past couple of years. So it's also important to understand and get some context of the capital structure of a company and where uh, do we sit in the territory of transfer pricing. So we can have that within a company. You can have debt and equity, and within equity debt, you can have different layers or a hierarchy of debt. You can have senior debt, which is unsecured loans, secure loans, or second lien loans, or you can have junior and subordinated debt, which can be bonds, mezzanine, or just normal subordinated debt. Now, the reason why this is important is because from a transfer pricing point of view, we pay particular attention to loans or any instrument that are in nature loan or debt in nature, mainly because that's the type of transactions that can have a tax impact. Equity generally doesn't have a straight tax impact because a lot of the times payments on dividends are not necessarily taxable, deductible, or subject to tax. So that's why a lot of the times we focus more in transfer pricing in debt instruments or debt in nature instruments. So let us just recap on some of the regulatory landscape associated with what regulates financial transactions. So our starting point as anything in TP is basically the arm's length principle in Article 9 of the OECD Model Tax Convention, where basically says that where conditions are made or imposed between two associated enterprises in the commercial or financial relations, which differ from those which would have been made between independent parties, then any profit which would, but for those conditions, have accrued to the one of the enterprise, but by reason of those conditions have not been accrued, or may be included in the profits of the tax of that enterprise and tax accordingly. So it's a bit of um, a tongue twister of an
Yeah.
article, but I think essentially what it's trying to say is that the arm's length principle needs to apply to companies that are considered or any parties that are considered related parties because they have to abide to what it is the arm's length condition, which is nothing different than the market price. So in other words, that the fact that you are related should not condition the fact that you should agree in theory at a market price. And this is the basis also for financial transactions and intercompany loans. So it's essentially making sure that when you enter into any financial transaction, whether it's loans, whether it's bonds, whether it's cash pooling, the arm's length price has to be agreed as if the control parties were unrelated. So in other words, the relationship should not have an impact in the price. So that's essentially how the arm's length principle works for financial services or financial transactions, which is nothing different than to other intercompany transactions. So in general, we will approach the way in which we will do a TP analysis will be very much similar to any other type of transactions, which is that we have to conduct as a step one some business and functional analysis, followed by an industry analysis, then followed by a methodology to price the transaction, and then a market benchmark to make sure that that price is a market price or arm's length. So if we see the example here, we have that company A has obtained a fixed rate of 10% medium-term loan from an associated person, which embeds an option to repay the loan prematurely without penalty. In the third year, the market interest rate began to decline to 5% at a rate lower than the fixed rate agreed upon with the associate person. In an arm's length situation, company A will execute its option to repay the loan, as it would not make sense to continue paying a high interest rate of 10%. However, company A did not exercise the option and continued to pay the higher interest rate. So in this scenario, IRS, or for that matter, any tax authority, will potentially not recognize the excessive interest payment and may disallow the additional expenses over and above the 5%, or may disallow the entire interest expenses. So I think this example is just to show that essentially when we have a financial transaction, or in this case a loan, the first thing that one needs to assess is whether the interest rate at the time that the loan was entering into, in this case 10%, is a market interest rate. Then obviously now the new views on financial on intercompany loans and financial transactions is that this interest rate should keep being monitored year after year, because interest rates are very volatile. So in this case, there is a decline to 5% of interest rates. So the new market rate is not 10%, it's 5%. And there is a option to repay the loan without any penalties. So market behavior is actually to exercise the repayment option rather than continue to pay a 10% interest rate, or renegotiate that interest rate at 5%. So that's essentially how majority of tax authorities will look, or will try to look at financial transactions or intercompany loans. Essentially, always trying to make sure that the transaction is what debt in nature, two, that the interest rate is a market rate, and three, that this transaction, or in this case loan, keeps being monitored, so the interest rate continues to be a market rate through the tenor of the loan. So maybe let's just think about how is this understood in the region. So Honchun, do you mind, in general, how is the approach in Australia?
Yep. Before I start, could you hear me clearly? Because I think someone said I'm soft, so I just want to make sure that. Okay, yep, sounds good. So I guess in Australia, in relation to the example provided above, right, Australia has certain mechanism in place for taxpayers to self-assess their financial transaction risk assessment on an annually basis, to ensure that, when on an annually basis, when you assess your interest rates, terms and conditions of your loans, for example, that it is up to date. It is more or less in line with the market environment, right? So they have mechanisms in place to ensure that you do monitor your intercompany loans closely. And I think in respect to Malaysia, it's more so the responsibility of the taxpayers to ensure that we don't have mechanism in place. But if you look at the overall TP rules and regulations, the most important point is to be contemporaneous, to make sure that your intercompany loan transaction, your financial transactions, are closely monitored, and making sure that if there are any changes by way of business, by way of any economic environment that would impact the terms and conditions, in this case maybe interest rates, then you need to then reassess, and to a certain extent having to have the opportunity to look at whether there's any renegotiation to be occurred, and then to reduce or increase the interest rate based on the market factor.
Thank you, Anchun. So I think in Singapore and in the region in general, the way we approach intercompany loans is, or financial transactions, is very much in line with OECD, in the sense that first you have to make sure that the nature of the transaction is correct. So if you're claiming that you have debt, then to make sure that the instrument is debt in nature as per the terms and clauses, and then making sure that the interest rate agreed is also an arm's length. I think one particular difference between Singapore and other countries in the region and Australia, I will say, is that Australia is the only country that actually have this self-assessment tool where you can really know. So Australia tax authority has been really good in putting out there what they consider to be a market rate, whereas the rest of the region doesn't have a lot of compass to self-assess, so they have to go basically on OECD principles. In Singapore, where the only thing that we really have, which we will discuss in other slides, is an indicative interest rate for low value loans. But other than that, we don't have that much. So I think Australia is probably the only country that does really good self-assessment to be able to uh, n- know upfront whether the transaction is high risk or low risk. Um, but in general, yes, we are looking most of the times at the principles OECD. I'd have to say that there is not as detailed e-tax guide in loans that there is for other transactions or for TP in general. So a lot of the times you are really, really relying on OECD principles.
Mhm.
So, Honchon, why don't you just start talking about loans and what's the general approach and how would you deal with loans from a TP point of view?
Yep, thanks, Adriana. I guess um, in relation to loans, I would first say a financial transaction. So when we assess a financial transaction before deeming it as a loan, so from what we have experienced, we have five key challenges that we generally face. First challenge is in relation to the substance of that financial transaction. Before proceeding to analyze whether it is a loan, the first crucial step is to determine the nature of this financial instrument as to whether in substance it constitute a debt or an equity, right? There has been a lack, from what I experienced, there has been a lack of debt equity analysis when testing a financial transaction due to a reliance of recognition of a debt in the financial statement. What I'm saying is that, in audit accounts, it may be treated as a debt, but without looking into detail, it may be otherwise. So it may or may not be accurate, especially when we have really complex hybrid instruments, for example, in place, which can be both a debt and equity in different circumstances. Hence, it's really important to determine, the substance of the financial transaction, whether it's in a debt in nature or not, right? So before we proceed, and you have gone through the substance phase, and the next challenge is more so the value of the transaction, the amount of transaction, or value of the loan itself, the amount of the loan that the borrower can borrow, right? It really depends on commercial reasons for the borrower and the capacity for the borrower to borrow a certain amount of the loan, right? So again, I'm basing it back to Australia, for example. Australia has a test called something called arm's length debt test, really to look at what is the arm's length amount that a borrower and the lender point of view can borrow, right? So that is another critical challenge. And the next challenge is obviously pricing of the loan, which is a core element when you're setting up a loan transaction, right? You need to make sure that it is arm's length, which leads to the next challenge. Obviously, the credit rating constitute part of the process to price a loan, but we would like to highlight the impact of an accurate credit rating. What would an accurate credit rating impact on the pricing of a loan? So there are a lot of cases involved that has really tackled the credit rating portion of the loan itself when pricing the loan, right? And lastly, the challenge obviously would be, as with all related party transaction, as Adriana has mentioned, arm's length principle would an independent party would they have entered into a loan transaction given an amount, given the terms and conditions and interest rates? Would they, in the independent circumstances, enter into that particular loan transaction? Right. These are the 5 key challenges that we will face. All right. So I guess when we looking at the first challenge, substance, right? Well, substance. What is substance in terms of a loan transaction, for example, right? The first point to determine the substance of a loan will be a contract. We can't emphasize enough the importance of having a contract in a related party transaction. And for intercompany loan transaction, it is a must to have a contract in place. Hence, the contract needs to have a clear terms and conditions for the loan itself. For those that have borrowed from a bank before, you would have received a loan agreement between yourself and the bank, right? You'd be able to look at various terms in the agreement itself, right? Most important thing for us, obviously, is the interest rate. Apart from the interest rate, you have the loan principal amount. You'll be looking at what are my repayment terms, what's the tenure, have I actually provided a mortgage or security to obtain the loan, right? And what happens if I don't pay? Are there any penalties involved, right? So similar principle applies here, right? So when we look at the contract itself, first we'll be looking at whether any repayment terms. Are there any repayment terms that exist within the contract, right? When I'm going to pay, what's the repayment schedule, what's the tenure, and then we'll be looking at purpose. What's the purpose of the debt, right? Is it to acquire capital assets? Is it for working capital purposes? And then we have obligation to pay interest, right? So we have interest rate. To what extent that obligation extend to, right? Can the borrower pay anytime, right? So that needs to be accounted for. And then we have right to enforce payment of principal and interest. That's a given. And then status of the funder lender in comparison to a corporate creditors or financial institution, for example. Then whether there's any existence of financial confidence or securities in place. Financial confidence may be the whether the borrower has to maintain a debt service coverage ratio, for example, right? If it falls below that financial covenant, what will happen? And lastly, if there's a failure of the borrower to repay, what will happen when the borrower fails to repay by the due date? Or are there any options to actually seek postponement, or are there any avenue in place in the event that the borrower fails to pay, right? So these are the key features that forms the substance of the loan. So we have to be very careful that the contract should have these terms and conditions in place to ensure that in substance they are a loan. All right, so next thing we'll be looking at is whether it's sort of similar to the substance wise in terms of looking at not just overall, but we need to be mindful of the domestic definition of a loan itself, right? So similarly, you need to adhere to the domestic rules in terms of your debt equity analysis to ensure that it falls within the definition of the loans. On top of that, there are other rules that we need to be aware of, which is the thin capitalization rules or the earnings stripping rules, where these rules have the objective to limit your interest deductions, right? So Australia has thin cap rules, for example, which has recently switched from a capital asset-based approach to an earnings-based approach, which is in line with the OECD earnings-based approach. I think Malaysia has followed the OECD approach, which is called the earnings stripping rules. So these are rules that, given the amount of debt, there may be interest denial when we calculate based on these rules. And for Singapore's point of view, what does Singapore has, Adriana?
Yeah, so we have probably one of the only countries which has a lot of flexibility in Southeast Asia, whereby we don't have any limitations on interest deductions. or think up rules. So for us, it's just basically is the loan a loan for domestic law purposes under the normal definition of what is loan versus what is equity versus debt. We have practice guidance, and there is one also in Malaysia about hybrid instruments, are how to decide whether something is debt or equity for tax purposes, basically. But we don't have any in Singapore. We don't have any limitation on interest deductions.
Mm.
So let's see this example just to explain a little bit of when a loan can be not a loan or can be a loan, depends. So we have company A is a leading manufacturing company, channels funds via equity and debt into a financial entity, and the finance entity provides funds to company B for USD 100 million at 8% interest rate. The terms of the loan are a tenure of 100 years, no repayment clauses for principal. Company B is required to pay only if it makes profit. So the question here is whether the loan from company B in country C is loan in nature, and does it have the features of the loan?
Yep. I think if you look at these the details of the loans itself, the terms of the loan, we need to fall back again to first a couple of things. The arm's length principle. First, whether an independent party would actually enter into this type of loans, and on top of that, looking at the definition of the respective domestic laws in relation to the loan itself, right? Does a loan, a normal typical loan in the independent party point of independent circumstances point of view, does it have 100 years of tenor, right? That's one thing. Does the loan have no repayment clauses, a normal loan repayment clauses for principal? And if you look at the last one is where the company B is required to pay only if it makes profit, right? So the condition is that there are no interest expenses being imposed only on and after that they have made profits. Does these terms and conditions relate to the substance of a loan, right? That's the thing that we need to analyze. So when we look at the interest rate as well, 8% interest rate, from what extent that will be at arm's length, right? So first you look at whether it's a debt or equity, then after which, whether the 8% interest rate makes sense.
Yeah, I think in general, in most countries, the key is that there is a real and clear obligation to pay principal and interest in a particular period of time, because that's the key feature of a loan. If the contract doesn't have that as a minimum, and there is not what is called a clear or a contingent obligation to pay the principal and the interest, then we are really looking at maybe an instrument that may be called loans, but it's not a loan. So I think that's the key takeaway, that the clauses and the terms need to be of obligation as if it was a third party.
Mhm.
So let's talk about price then. Once you clear the substance and all of that, and making sure that the instrument is what you're saying that it is, then that's when we worry about the price, right? So what do we need to look when it comes to the price?
I guess this one is in relation to indicative interest rates. So I guess in Singapore, you use the term indicative interest rates. In other countries, it may be deemed, I guess we can term it as sort of a safe harbor rates or certain indicative rates that is available. So the first point, are indicative rates available in the country of the borrower, right? This is the first thing we need to assess whether there are any interest rates in place. Singapore would have, Australia would have, Malaysia unfortunately does not, right? So when you have determined that indicative interest rates is available, right, then you need to look at the criteria to be able to utilize these indicative interest rates. And the next question would be whether these indicative interest rates, are they acceptable, right, from a lender's country point of perspective? This really important question. It's a very gray area to understand. In terms of these indicative interest rates, it is only available for that particular country. But having said that, when the respective tax authorities provide these indicative rates, these rates are more or less based on publicly available rates from banks, for example, right? Hence, to a certain extent, it's not just looking at the lender's point of view, you're looking at the borrowers, and to make sure that when you have indicated interest rates in place, what are the impact and what are the leakages in place, right? So obviously, the indicative rates provided by Australia, they will not be acceptable by Singapore. But having said that, you need additional analysis to ensure that these indicative rates are of arm's length nature, right?
And I think from memory, but please correct me here, Australia indicative and mainly for AUD loans, or they can be also for multi-currencies?
It will be only for AUD loans.
Yeah, so the logic there sometimes is that the country that issued indicative rate, it issued in the currency of the country that of the currency of the country, right? I think the only exception is actually Singapore, that even though their example is on SGD, they do provide an avenue for you to do a currency swap to be able to use the indicative interest rate for a different currency. But we have the same challenge, which is that, yeah, it can be acceptable for Singapore. But for example, if I'm extending a loan to Malaysia, then IRB can decide not to accept it because it's not mandatory for IRB. So I think there is a limitation with safe harbor interest rates, which is the acceptability in the corresponding country. So for example, if we see this example here, company A is a distributor of electronics and provides a loan of AUD 13 million. So the question is to a Malaysian entity, company B. So the question is, do I have any safe harbor interest rates or indicative interest rates that I can make use of in this example?
Yeah. Australia has have what we call a simplified transfer pricing record keeping options, and it provides taxpayers certain type of transactions with safe harbor rates. So in this case, they have an outbound loan to Malaysia. So the criteria for Australia is that it has to be below 50 million. The Australia cannot be loss making. It provides a fixed all-in interest rate in 24 as a 5.81%. So if you satisfy all these criteria, then you can apply or use that we call STPRK options. But in this case, obviously, in terms of Australia, you can use it. But as Adrian has mentioned, Malaysia may not accept that rate itself.
Not to mention that also a practical point, but that's not the point of discussion today, which is would it make sense to lend in AUD to a company in Malaysia? So that's a practical part. But I think even if the company A was in Singapore, you all have the same issue, which is like, yes, we have the indicative interest rate, but Malaysia may not be required to accept it. One person is doing a comment here, which is not a question, it's actually a relevant comment, which I think is a good one, that indicative rates are generally higher also. So the receiving country might not agree on that rate. We have done a comparison on Singapore side, and I think in Australia side we have also done. Yes, I agree. It's slightly higher, not by a lot, like not by a lot of basis points, but yes, it tends to be a little bit higher. So I agree with the comment of that person. Thank you very much for the person who put it there. So in that case, then what other options do I have to price my loan?
Yeah, I guess for next step, so the next thing is to assess whether there are any internal comparable uncontrolled price available. So cut here meaning whether there's any internal data that can rates that we can use to apply, right? So if you look at this example, we have country A lender and country B borrower with loan A and loan B. Now, in the preferred cup on a hierarchy level, we'll be looking at first on the lender's perspective, in terms of looking at the loans provided to a third party and the interest payment. So this is a clear indicative cut method whereby you can look at the loans being provided. So for loan A, what's the interest payment, and then use that data then to online it to the related party Y. Generally, this not likely the scenario, and more or less, because then we'll be dealing with a financial institution. But the next preferred method will be looking at the borrower's point of view, right? So when you look at borrower's country B, we have a third-party bank lending money to related party Y, so loan B. So the interest rate in this case, we're looking at borrower's point of view. The interest rate payment then can be used as an internal cup to apply to the intercompany group loan transactions from X to Y, right? So this will be the second avenue for the internal cup. And then what happens if both we do not have loan A and loan B, for example, right? So then if both loans are not available, then really you'll be looking at whether there are any third-party arrangement in place with, again, we're looking at similar circumstances, similar terms and conditions, whether there are any third-party borrowings in place that we can actually utilize, right? So these are three of the examples that we can use as an internal cup. Yeah, and the next example is a clear internal cup that we can use. So basically, head office Germany, they borrow money from a third-party bank and then on lend it to Thailand subsidiaries. In this case, it is very similar to the ATO expectation as well. There's another self-assessment to self-risk assessment to for Australian taxpayers, whereby they'll be looking at what we call a third-party relevant debt. And in this case, it mirrors the debt that the head office borrows to the debt that head office on lend it to the Thailand subsidiaries with the same terms and conditions, right? That in a hierarchy level, that will be the first in respect to the self-risk assessment.
Yeah, so I think Singapore will also uh, uh, look into this. So if you look at the tax guide said that the first point of reference is not the indicative interest rate, it should be actually the internal cap. So whether the taxpayer or or a related party within the group has bank loans and that being used as the reference. And I think Malaysia also it is similar, right?
Yeah.
So I think this is from the OECD. So I think generally the internal cup is usually the first point of reference. Now, question here, which we always get asked, is okay, let's assume that is not a loan. Let's assume that I just ask via email to my bank to quote me what the interest rate is today. Is that considered an internal cup?
That used to be an avenue that a lot of taxpayers have used, but gone are the days where we are able to use a quote as an analysis as the internal cup to sort of defend against why we use the quote interest rate instead of, because the which is quite valid because that quote, an agreement has not been put into place, right? So it's just a quote.
Yeah.
Only as and when you enter in an agreement with the third-party banks, then it really translates into a independent circumstances.
Yeah, I guess the distrust or lack of trust of quotes is because it's not a fixed commitment. It's
Mhm.
just I'm just telling you I think this is what the interest rate is, but I'm not committing to actually give you the money. So I'm
Mm.
not really entering into a risk. Plus, sometimes depending if I have a good relationship with the bank, it can be viewed um as it can be manipulated as well. So that's why when we're talking about internal cups here, we're talking about actual contracts being signed and entering into with the third party, whether it is a bank, which 90% of the times is a bank, but actual contract being entered into it. That's the key point here. So then if I don't have that, what else can I do?
All right, other avenues to price a loan. So when we look at CUP, we have actually internal CUP, external CUP. So we have explained what internal CUP is. External CUP would be our traditional benchmarking comparability analysis, searching for similar agreements, loan agreements in place in the database to come up with the arm's length interest rate. And the next one, actually, I've got the group of cost of funds, sorry. There's a cost of fund element as well. That's another avenue. So this cost of fund is actually equally important. In Australia, again, I'm going back to the risk assessment. You guys can search for it. It's PCG 2017-4. Now, in the self-assessment tool, what they talk about is, first, we have hierarchies. We have third-party relevant debts. We have relevant debts which has similar terms and conditions but does not mirror the intercompany loan transaction. And the third one is group cost of fund, right? The reason why these exist is more or less post Chevron case, whereby the group does not look at the group cost of fund, does not look at internal borrowing. So with this in mind, we have another avenue called cost of fund. So we'll be looking at the cost of fund of the lender, right? What are the financial costs in place of the lender? What's the effective interest rate that the lender has in terms of their internal group cost of fund? So that's another avenue for taxpayers to actually price the loan. Oh yeah. Let's talk about external CUP, where we are doing the benchmarking analysis. The first one, which is very important, which I mentioned earlier, is the credit rating analysis. Now, credit rating plays a huge role in terms of setting the price on intercompany loan, right? Credit rating by way of S&P, Moody's, or any other agencies, whereby they look at the borrower's point of view, the position of the borrower, whether they are of a investment grade company or a non-investment grade company, where investment grade company would have a better interest rate, while it's riskier for a non-investment grade company, hence it will have a higher interest rate, right? So credit rating analysis, then we have a benchmarking analysis to come up with the independent loan agreement with the interest rate, interest rates. And the third one is important, whereby first we need to look at compliance with the respective legislations. We need to demonstrate the commercial reasons why the borrower and lender has entered into this intercompany loan transactions. We also need to demonstrate, whether the borrower is capitalized in accordance with the arm's length principle. And lastly, of course, the TP analysis would need to be performed at the time of inception, assuming that the terms and conditions does not change for the tenure, right? This last part is important in the sense that when we looking back, we still need to closely monitor, right, marketing changes, what will impact to the terms and conditions, right? So we have to keep that in mind.
Yeah, because even in Singapore, the IRS has changed the view a bit. They are actually of the view that for long-term loans, which they have not defined what long-term loans is, whether it is 3 years, whether it is 5 years, the interest rate should be looked at the inception, but also through the year by year. So you have to monitor more closely that you will do with what is short-term loans, but unfortunately they haven't defined. So that's a bit of a change of view. Before we only look at it at the inception and that was about it, but now they have changed the view on this. So I think we have discussed already along the lines the country perspective. Why don't we just move on to cash pooling, and just a reminder for people that we have a Q&A button where you can post your questions. So let's just go very quickly through cash pooling and financial guarantees, because the cash pooling has is becoming more common, and it's good to understand how one can look at it from TP point of view and what's the TP triggers. So I think cash pooling, what you have to keep in mind is that the reason for a cash pooling is generally optimization of cash, where you have a master account global leader, which is generally a HQ that has an account with the bank. And each of the subsidiaries will also have kind of a sub account with the bank to manage the cash pool uh, and bring the cash or the excess cash from the subsidiaries into the master account. And then the HQ as the leader will manage the cash, basically to make sure that the companies with excess cash can lend to the companies with shortage of cash. That's essentially what you do. And because you're doing that, then the question is how what transactions can be triggered. So as I was saying earlier, the reason for the intra-group cash pooling can be to mainly to minimize the cost of funding, because it's better to fund internally than finding externally. Externally is always going to be more expensive. Improve administration and centralization of treasury expertise, maximize the group return on the cash as better terms can be negotiated with the bank, and centralize monitoring the cash position of the group. But in essence, it's just basically better management of the cash and minimizing the need for external borrowing. So the first thing that one needs to do is to set up an arm's length interest rate for the credit and debit balances. So as we were saying earlier in the slide before, we have that a master cash pool and leader, and then we have the subsidiaries. So the subsidiaries that have excess cash will have, I think it's a credit account, a credit amount, and the ones that have shortage will have a debit amount. So in other words, some will kind of lend and the other ones will borrow, the ones that have shortage of cash. So both will have to have an interest, because whoever is lending basically is giving up their cash. So that has to have an interest. And whoever is borrowing also has to pay an interest because is using the cash. So that will be the first important aspect, determining what is that interest rate. And so for the cash pool in participants, what's the arm's length or the market interest rate for the credit and debit balances? And then the second point is the arm's length remuneration for the cash pool leader. So as I was saying in the example, there will be a HQ or a master leader. So what is it that cash pool leader should earn? Is it a service provider? And if it's a service provider, should earn a cost plus or should earn a interest rate in between for managing the cash. That's the two angles of the cash pooling. Obviously, like any other transaction, the cash pool has to have a proper contract in place that define the roles of the cash the cash pool participants, and also what is the interest rate and the remuneration of the cash pool leader and the participants as well. So that's from cash pooling point of view. Then the second thing is financial guarantees and how do they need to be addressed. So essentially an intragroup guarantee is a transaction whereby we have a company B that obtains a loan from a bank and pays a guarantee fee to company A, because the guarantee A is serving as a guarantor, giving a financial guarantee to the bank. And the reason why it will do that is either because the bank doesn't lend to company B without the guarantor, or also because it wants to reduce the interest rate that the bank is offering significantly by having the guarantee. Either way, this is considered as a payable service kind of a thing, whereby the guarantor is providing a benefit to the guarantee, in this case, company B. And because of that, there has to be a guarantee fee payment from company B to company A. Now, for this guarantee payment to happen, the first thing that we need to look at is again substance. And the key substance in guarantee fees is the contract. So today, the old view of having implicit guarantees doesn't exist anymore. For a guarantee to be chargeable and to provide a benefit, it has to be explicit. In other words, company A has to provide explicitly that guarantee and serve as a guarantor to the bank by a contract. That's what is called explicit, not by a notional understanding. It has to be by a contract. So that is key. Once you have the contract in place, then the question is, so the guarantee fee can be understood as chargeable. And if it's chargeable, then you will have a tax deduction of that guarantee fee payment. If it's not chargeable, then obviously there is no question of deduction at all. Or there is not even a concept of deduction because it's not chargeable. And guarantee fees that are not chargeable are mainly the ones that are implicit. Explicit, that's why it's so important to be explicit, because explicit will give you the basis for the guarantee fee to be chargeable. Then the question is, what's the arm's length guarantee fee? So in other words, how much can I charge for that guarantee? And that's where we can have different ways. One is internal cap, which is basically looking at any internal guarantee fees that have been obtained by third parties. And then the second option is if that's not available, and it's a bit like loans. Are there any guarantee fees that have been offered by third parties, either to the guarantor or to the guarantee or to any other entity of the group? And then if that's not available, then going down the path of external comparable uncontrolled price by doing a search and potentially doing either the cost benefit analysis, which is basically coming to the value of how much is the guarantee giving a benefit to the guarantee company, and how much interest is saving, and then splitting that saving between the guarantee and the guarantor. And that is basically the guarantee fee. So in other words, if you're saving me 4% interest rate, then I might split the 4% in half, which is 2%, and then maybe that's what I pay to the guarantor. But I'm just giving these numbers just for example purposes. Is in no way, shape, or form advice. Or I can go down the path of looking at financial guarantees for insurance, which is basically a way in which a guarantor also offered a obligation or a guarantee to pay if someone default in an obligation. Or we can also look at commitment fees. So pricing a guarantee fee is not straightforward. I think one of the most, I wouldn't say easier, but maybe technically correct approach is the yield approach. It's just that coming up with that saving it can be a bit challenging. So in the region, I think because guarantee fees and cash poolings are not that common yet, cash pooling being more common, we follow very much the OECD principles, which is what we have explained today. How about Australia and even Malaysia?
I think Malaysia follows the OECD. Australia, similar process, but just to bear in mind that the safe harbor rate I was talking earlier, it doesn't take into account guarantees. So the interest rate is just the interest rate portion, and the guarantee will need to be assessed separately, right? So
Okay,
it doesn't take into account the guarantee.
okay, understood. Um, I think just final tips to keep in mind before we open for questions. I think just in general, like in anything of TP, understand the income or an expense risk or tax risk of the taxpayer, and whether the financial transaction, whether it is loan or guarantee fees or cash pooling, can be subject or can create a tax leakage for the tax authority in the country where the taxpayer is located. Do you want to go with the second one?
Yeah, I think I would just say my key tips which is, I think, the very important one, which is substance. Really, really need to look at the debt equity analysis. On top of that, really, I think taxpayers have not really taken into account the earnings stripping rules or thin cap rules closely. There has been certain changes to the rules. I think it's good to look at, because this involves the interest deduction, and really, if you are being denied, then it will impact your overall tax position. So yeah, that's really important.
Yeah, I think the interaction between domestic tax rules are very important to assess first. What's the tax impact, and then look at TP and then checking the limitations on interest deductions, I guess.
Mm.
So with that, let's just move on to some of the questions. There are a few. Let's see what is it that we have. So an interesting point here. What happened if my cost of funds is higher? Let me just answer live. What happened if my cost of funds is higher than the rate I obtained by a benchmarking? Can I follow the benchmarking rate and incur a loss by lending?
Yeah, I think it really depends on the overall picture. Again, we are looking at first the terms and conditions of, let's say, your cost of funds. Why is it high? What's the purpose of the borrowing? Why is it higher than the benchmarking? Secondly, when you perform the benchmarking, so your cost of funds will provide sort of a guidance in terms of whether you're on the right track in relation to the benchmarking. Following the benchmarking rate, you really need to make sure that the benchmarking is performed accurately, and making sure that your cost of fund does not relate to your lending purposes, because it really depends on what you lend it for, right? Different circumstances will have different rates.
I think another point here is that from a borrower point of view, it might not be an issue because your benchmarking, your interest rate is a bit less than what the cost of funds is. But I think
Mm,
from a lender point of view, is a problem. So, for example,
mm,
if it was IRAs or an IRB, I think they will struggle to accept as to why you're the lending at a loss, because a third party would not lend at a loss.
mm,
So I think it would be hard for the tax authority of the lender to digest, if you ask me.
mm.
There is another question here. In Sri Lanka, we can obtain the foreign loan interest rate for different terms from money exchange agent. Could that be considered as external cap?
That's
I-
a
Is that
interesting one.
like, yeah, I know, is that like bank rates or what?
Yeah, and for different terms means, because again, I'm gonna fall back to the terms again, like the nature, what's it for, what the foreign loan interest rate, does it have specific terms for different
Ah,
terms?
he's
Mm,
clarifying down. Yes, it's a bank rate. Okay, this is a
ah,
good question because actually it brings us to one thing that we maybe should be a little bit clear, which is bank rates is not uh, um, bank rates are not the margin, because
mm,
bank rates are interest-free rates. So usually if you are charging a bank rate only, then you're giving a risk-free rate. So in general, for intercompany loans, you don't use the risk-free rate. You have to use the bank rate plus a margin. So now that you're clarifying that it's a bank rate, actually no, you cannot, because the bank rate is a risk-free rate. From TP point of view, your interest rate should be your base rate plus a margin.
mhm.
If you do only a bank rate, then you're just doing a risk-free rate,
Yeah,
which is probably not correct from TP point of view, because no one will charge a risk-free rate other than a bank.
yeah, yeah, like base rate for like your interbank offered rate, but which has now changed to SOFR SORA type.
Yeah,
Base
but
rate.
all the indicative rates, right? Even in
Mm.
Australia or Malaysia, we don't have. But in Singapore, is bank rate plus a
Plus,
margin.
Yeah.
So bank rate plus 2.2%. And in Australia is
Australia is the all-in rate, so
ah
it's 5.81, but
ah
obviously it includes the bank rate plus the margin
yeah.
to derive the 5.81.
Another question, is there a simpler way to support guarantee fees that IRAs will accept? Not really. I have never come across a simpler way to price a guarantee fee. It is a difficult topic. So if it is material, you kind of have to look into either internal quotes or going down the path of looking at the saving approach. Mm, there is another one that says whether the amount due to directors for providing funds to finance the purchase of real properties payments on behalf of a company is more likely to be taken as equity or loan transaction. I think it depends of how you are recording it from accounting point of view, because if you are giving the funds and treat it from a balance sheet point of view as equity, then it's equity, right? But if you are treated as loan, then you could say that is a loan unless it's a quasi-equity loan.
Yeah, I guess again it falls back to the one that you have mentioned earlier about the obligation to pay, the terms and conditions, and even in Malaysia, for example, when we have amount due to director, there's a specific ruling in place to tell you that you should charge that interest rate needs to be imposed, and what's up.
Oh,
So that's really like because in Malaysia there are a lot of amount due to directors, amount due from directors, so they actually have a separate ruling in place to deal with the directors loan transactions.
oh, I agree with you. So now I get it. So in the balance sheet is amount due to director. I do think that then I agree with you that is it depends on the nature of it.
Mm,
Right? If it's of the nature of equity and has fulfilled the requirements of equity, or if fulfill the requirements of loan.
yeah.
Then you have to look at the specific guidance on hybrid instruments, I guess,
Mm,
to define which of the two is it.
yeah.
Okay, so I think those are all the questions that we have for today. If anyone wants to follow us on YouTube, we will appreciate it to like and subscribe. There is a lot of material that we're always putting in our YouTube channel. We don't charge for webinars, we just like the likes. And what are the upcoming webinars? You can always follow it up. There would be some webinar of global minimum tax. We have mastering TP documentation and benchmarking in association with ISCA and staying ahead of trends and development, also in association with ISCA, and also ACCA technical forum next week, 24th of September. We'll be talking about transfer pricing in Singapore and Malaysia. And with that, um, we can close our webinar for today. Any other comments, Juan?
Nope, I think that'll be it. Yeah. Yeah.
Okay. Thank you, everyone.
Thank you.
And
Oh
one
yes.
very important thing.
Yep.
We are very pleased to be TP Minds Asia sponsors. This conference aggregate the biggest forum of transfer pricing
Mhm.
and enthusiasts in the region. It will happen on the 2nd and 3rd of October. Um, in Singapore, you can check our social media. We have there options for people to come and talk to us live, not virtually.
For sure anymore.
We are very excited about being sponsors of TP Mind Asia 2014. And if you want to reach to any of us, here is our emails, and follow us also in social media. We are everywhere, literally: YouTube, Facebook, LinkedIn, Twitter, and Instagram. And with that, thank you everyone for being here today, and we hope we can see you again. Thank you.
Thank you.